Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey there, everybody. Nate Miller here with Miller Retirement Group and host of Retirement Rescue Radio. Long time no talk. It's been a little while. We've been very busy here, and you know, every time you incorporate something new, sometimes other things need to get slid off to the side for a little while or a season. And that was the podcast here for several weeks. And we're growing. That's the good news. So we've got, I've been hiring quite a few more people for a number of reasons. One, we're growing into new markets. Two, we want to make sure that we've got enough clients to make sure that we're getting good service for enough employees that we're giving good service to our clients. And so we've been hiring more people here too. So we're definitely growing. Things are going well. You might see a couple other, or hear, depending on how you're consuming this, a couple other advisors on our podcasts here in the future as well. So things are going well, but yeah, had to kind of pause the podcast there for a little while. And but now I want to go through a couple things here today. We're going to go through some fun stuff and also some financial stuff. We'll try to make those two the same, fun and financial. But two, we all kind of want to give a little bit of an update on what's been going on this year here, since the podcasts have been out for a while, so we haven't touched on a few topics. So inflation, interest rates, stuff like that in the market and where things we're seeing. But as far as the fun thing, I want to go over that first. And maybe it's fun for you guys. It actually wasn't as fun for me because I just received my very first invitation to a retirement planning seminar. So yes, we get those as well. And I guess that means I'm officially old enough to start receiving those. Don't worry, guys. I don't have any plans on retiring anytime soon, but apparently I'm on some kind of list that thinks I'm going to be retiring soon. And so I wanted to take this opportunity, though, to help all of you out there that are getting these invitations on a regular basis on how to really understand who it is that you're going to be listening to. Because those little tiny, small print disclosures that you find on a lot of these actually lets you know what type of advisor you might be coming to listen to. And so I want to help you guys if you're looking for, an insurance only guy, or if you're looking for a securities only guy, or maybe you're looking for someone who does more, complete overall financial planning, then each one of those I'm going to help you understand how to read these invitations so that you know what type of advisor you're looking for, which one of those that you're looking for. And one is not necessarily better than the other. It just matters on what you want. Like if you're looking for just one specific thing on the insurance side, well, maybe you should talk to an insurance only guy. If you're looking for just one specific thing on the security side, maybe you talk to an advisor that's all he does. But again, if you're looking more for an overall plan, you probably want to look for somebody that's in both of those worlds. So this specific one, I'm not going to give any names of any companies or anything like that, but I just want to help you guys understand the verbiage that you want to pay attention to in order to understand what type of advisor you're going to be listening to whenever you go to any of these retirement planning seminars. So this one right here after the invitation and after it talks about where it's going to be held, what restaurant it's going to be at, the disclosure says insurance products offered through, I'm just going to call it XYZ company. All guarantees backed by the financial strength of the issuing company. We do not offer investment, tax, or legal advice. Always consult with your own qualified advisors. And then it says they're not affiliated, approved, or endorsed or authorized by the Social Security Administration or any other government agency. And the event's not sponsored or endorsed by the restaurant. That's normal language right there. None of the presentations are ever sponsored or endorsed by the restaurant. They're just the venue, and the views, information, and opinions expressed are of the presenter and do not necessarily represent those of the restaurant or its employees. And that right there is standard language. The part you want to pay attention to is how it says insurance products are offered through, XYZ company. All guarantees are backed by the financial strength, and it says that they don't offer any type of investment, tax, or legal advice. So that's the part you want to pay attention to. And it says specifically insurance products. It doesn't have any information in there about any securities that are offered. And matter of fact, it says that they do not offer investment services. And so that means that this person would be insurance only. That would be all they sell. And actually, I went out to their website because on the invitation, it does have their name on here. And yeah, there is no mention of any securities being offered by anyone, right? And so that is how you know that this person is going to be an insurance only person. They're not going to be talking about the market and investments because they can't. They're not licensed to. So it's going to be insurance only. And just to give you guys a little, I want to say a comparison or a contrast. So our disclosure, it does say, insurance products are offered through the insurance business Miller Retirement Group, but it also goes on to say Miller Retirement Group is also an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. And so there is the disclosure that mentions securities, right? So we've got investment advisory practice, right? Products and services through AE Wealth Management. And so that's how you know. And so we're both. So we have insurance licensed products. We have the securities products. So that lists both of those in the disclosure. If somebody was not insurance licensed, it wouldn't have anything in there about insurance. It would basically just say securities are offered through, in my case, AE Wealth Management, or if it's through somebody else, it could be ABC Securities, Incorporated or LLC, whatever. But it will mention something about securities or investment advisory services. And so that's how you know whether or not somebody is in the securities industry. And if it has both disclosures, both insurance disclosures and securities disclosures, that person is in both of those categories. And most likely, from my experience, I'll just say that from my experience, is going to be an advisor that does more holistic planning rather than just transactional stuff. And so there you go. Hopefully that helps you guys understand who it is you're looking for, so you can better determine who you actually want to go end up hearing from. Right. So there's the fun stuff right there. I'm old enough now that I'm starting to get those. So yeah, end of an era, I guess. The other thing I would like to talk about here is, kind of just where we see things right now, and what's been going on as far as interest rates and inflation and all that. So bear with me here. So we've got good news, bad news, I guess. And good news is the CPI, the Consumer Price Index, for April, it came in at 4.9% year over year, which is slightly under the 5% reading that came in March. And, it's not much, but it should be enough to keep the Fed on course to pause their interest rate hikes at the next meeting in late June. And so for those of you that might be keeping score at home, the CPI was 9.1% in June of last year. So it's improved significantly over the last 10 months, but it's still more than double what the Fed's target is. Fed's target is 2%. And so we're still higher than what we'd like. And the producer price index, so we just talked about the consumer price index, the CPI. The PPI, the producer price index, that generally reflects supply conditions across the economy. It actually went to 2.3 in April, down from 2.7 in March. And so that's good news for consumers. Lower producer costs usually will mean lower prices for consumers in the following months. So the fact that the PPI, I know there's way too many acronyms, guys, I apologize here, that producer price index, the PPI, since that has gone down, we're probably also going to see the CPI continue to go down even further. So good news. However, while the Fed may not be increasing rates anytime or again soon, cuts are not quite on the horizon yet. The New York Fed President John Williams said last week that he does not expect a rate cut later this year. And in talk to the Economic Club of New York, Williams also commented that we haven't said that we're done raising rates. So they said they're pausing. They did not say that they're cutting, and they did not say they're done raising rates. So that's important to remember as well, because like I said, inflation is going the way that we would like it, but it's still double what the Fed would like to see. So even though they might be talking already about pausing, they may not necessarily cut, or they might actually even raise them later on if the interest rates if the inflation rates don't come down where they'd like. because it's not slowing as quickly as the Fed had hoped. And there's been other signs of a cooling economy that promises for that, rate hike pause as well. The Department of Labor did report that initial jobless claims from the week preceding, what was it, May, first part of May 13th, right? So here pretty recently. They were bringing in a total of, they increased by 22,000, bringing it to 264,000 claims for the week. That is the highest level since 2021, and could be a clue that the labor market is beginning to slow down somewhat. So from a labor market standpoint, that's always bad news. But when it comes to inflation, apparently more jobless people is good. It's interesting. The once red hot housing market has also slowed down quite a bit. The National Association of Realtors reported that home prices fell in nearly a third of the U.S. metro areas in the first quarter of 2023. That doesn't mean home prices fell by a third. The prices fell in nearly a third of the U.S. metro areas. And that's going to be attributable to a couple different things. First is mortgage rates, which are in the 7% ballpark right now. And the second is the higher monthly payments that are going to be due to those higher mortgage rates. In my opinion, that's the same thing. Basically, it's not two different things. It's the same thing. And so right now, what's interesting is the monthly mortgage payment on an existing single family home with 20% down is currently $1,859, an increase of 33% from just a year ago, a 33% increase in the monthly payment. And so if you're at 1,800, 33% is basically 600. So if someone's normal payment was about $1,200 a month for their mortgage, now it's $1,800 a month for the same dang house. That is crazy. That's too expensive, in my opinion. And also, I talked about this in one of my earlier podcasts this year, the whole debt ceiling debacle. It's starting to pop up again in news. Congress still hasn't reached agreement on what to do about it, despite Yellen's warnings that bad things will happen if we don't take action by June 1st. A short recap, the debt ceiling was raised by $2.5 trillion in 2021, and the government maxed out that limit in mid-January. And if the ceiling doesn't get raised, the U.S. may default on the debt. So what's going on with that is the impasse is happening along party lines right now. Republicans have said that they will vote to raise the ceiling if spending cuts are also enacted, while Democrats just want to see the ceiling raised with no promise of cuts. And so what happens if the parties can't reach agreement? The U.S. might not be able to pay creditors salaries for federal employees or veterans benefits, and it also won't be able to fund Social Security if that happened. So the U.S. has never defaulted on its financial obligations, but it came close in 2011 when Congress waited until 2 days before defaulting. And back then, the back and forth bickering and stalling depressed the stock market and led to higher borrowing rates for the U.S. So, yeah, sounds familiar right now. And the FDIC. So now we're talking about some of the banks, that had been failing here recently. And I did talk a little bit about that before I took my little hiatus from the podcast for several weeks here. But they have said that it plans to charge the country's top banks about another almost $16 billion in additional fees over the next 2 years in an attempt to replenish the deposit insurance fund following these recent bank crises or crashes. And each of those banks will pay a specific amount based on a special assessment of which banks benefited the most from the coverage of uninsured depositors. And so we also know that lending officers at a lot of these major banks have been tightening their standards in response to some of these banks failing. Because in my opinion, even back when I was in the banking industry where we were auditing banks around the 2008 timeframe, when that happened, the whole mainly a lot of what we saw, the banks that failed were the ones that got too greedy as for what banks are allowed to do, how much they can lend out versus how much they have on deposit. The ones that loaned out a higher percentage of what they had were the ones that ended up getting in trouble. So that's the issue, is getting too greedy on what they loan out, and in the cases here recently, too narrow of a clientele, not a diversified enough clientele. Those two things have led to a lot of these recent bank failures. And so we're going to be continually monitoring this. So I still expect the rest of this year it's going to end on a positive note for this year. I'm not sure if we're going to get back to the levels that we were at in January of 2022. I think we could get close, but I don't see us quite making it back there. I mean, that's my own prediction here, based off of what I've read and how I normally see things going. 76% of the time the stock market is up. It was down last year, and that corresponds with usually, presidential terms, right or left, it doesn't matter. Republican and Democrat, doesn't matter. The first year is usually good. The second year is usually bad. And the third and fourth year are usually decent. And so last year was the second year for Biden's presidency, and the market did horribly. And so this year and next year, we plan on having the market up. There's a lot of other factors that play into that. That's not the only one we're looking at, but that's definitely one of them that usually plays out that way. And so far, how the year has started, that has held true. It is not going to be a straight shot to the end. It's going to remain extremely volatile. There's not a whole lot of news out there right now that's causing the market to go up, so the market is still going to be very, very cautious, because anything can really happen to cause it to have an issue. The Fed could say, hey, we're going to start raising rates again, and that'll be negative. Russia, Ukraine can have something crazy still coming out of it. There's still a lot of things that can happen to cause a lot of volatility, but still, regardless of what goes on now through the end of the year, I still believe that this year will end up on a positive note. So there we go. Nate's old and back, and this year I'd end up positive. So I guess bad news, good news is kind of how this goes. Or if you want to make fun of me, then it's all good news for you guys, and just one teeny tiny little bad news for me. I still have people tell me that I don't look like I'm 43, so I guess I got that going for me. But anyway, thanks for listening, guys. Thanks for tuning in again, and we will start releasing these on more of a regular basis again going forward. Until then, guys, enjoy and thank you, because we're always trying to bring you guys enough information to empower you to live the retirement you deserve. Take care.